Incorporating your properties into a limited company. What about capital gains tax and latent gains? Well, those golden nuggets are contained within this video. Let's talk about incorporation relief.
Oh my goodness.
Again.
We're getting some really great questions again.
I mean, we kind of talk about this process whereby people talk about using smart companies, and we work with Property 118, Mark Alexander. Hey, if you're listening, they do a fabulous job of moving people that need a limited company in a company structure. They do all the kind of incorporations. We work with them to do that. But the one thing I would say is that you can get so many reliefs like CGT, stamp duty, land tax. Stamp duty, land tax is a mitigation through the incorporation relief, so you certainly can get that. But what I want to bring people's attention to, and it's tripped a few people up actually, is capital gains tax. We did some internal training about this to say, well, what really does happen? So if you've got a market value of your properties, let's say it's £1 million, and then and it was originally purchased for £500,000. So market value compared to the original purchase price is £500,000. Ordinarily, if you sold those properties, you would have a capital gains tax on that £500,000. But because you're using this incorporation relief, then it's deferring CGT. Please do know that word defer. It's not mitigation, it's deferral. So that £500,000 gain will crystallize if you eventually sell the company on. And I think some people aren't aware of that because I think they're saying, well, I want to incorporate, get all the benefits, and then ditch the company in a few years' time. And if that's the case, then it's not really right for you. So I would say before you go on the merry-go-round of incorporation of your properties, ask yourself the kind of key question is it really right for me? Should I do it? Given that there could be extra finance costs, there could be accountancy fees, there'll be other professional fees as well, conveyancing fees as well. And then will you do it if it's really right for you anyway? Because we do see people that we say incorporation is right for them, and then they're told it's £30,000 and thinking, oh, I don't be paying £30,000, grumbling about it, which I appreciate is a lot of money. But if it's saving you £100,000, I do see people kind of sit on the fence and then don't do anything for 5 years, then totally regret it.
The one thing I was going to add actually is there's a very nasty twist in the tail. And it's called latent gain. And I'm not going to go into a lot of detail on this because otherwise, I mean, we could be here all night on this topic. It's such a great one. But there is a scenario where even though you are mitigating and delaying certain taxes like capital gains tax and stamp duty, land tax, if you're able to follow incorporation relief, if you happen to have a sizable amount of debt against the portfolio and that debt now exceeds the original purchase price of the assets when you first bought them, woe betide you doing incorporation relief, because you're going to be on the sharp end of a capital gains tax bill immediately on incorporation. Maybe not for all of the value, but the moment your debt is bigger than the original purchase price of your portfolio, when you add it all together, I'm afraid you're going to still pick up capital gains tax pretty much immediately to incorporation. And that can put people off. Sadly, I've come across a couple of scenarios where, not necessarily 118, but I've come across a couple of scenarios where clients were completely unaware of that and had massive capital gains tax bills that we were just able to stop before they'd taken that one step that would have been too far to backtrack from. So just be mindful, it doesn't necessarily resolve all the pains.
I do want to bring that to life because we had a situation similar to what you just said, whereby they, and I'm going to create a video of this, a short video of this, of why the buy, refurb, refinance strategy can harm your incorporation. Let's go for an example here, but imagine that you bought a property for £100,000, you did it up, and then it's now worth 200,000, and you remortgage it at 150,000. Well, when you come to incorporation, you like Louise says, you stung yourself because the difference between the £150,000 mortgage, which you refinanced, and the £100,000 purchase price of the original property, well, that is going to be causing you a latent gain. So you could have a 28% tax bill on that £50,000. And if that's been your strategy, and I know on YouTube it's very popular about buy, refurb, refinance. There's so many people. I mean, even Kevin Wright, who's such a great guy, he talks about it as well. And it's a good strategy, but it can sting you when it comes to incorporation, because you've now got this huge latent gain, which no one talks about. So it's often, yes, you can get all these reliefs, the incorporation relief, a CGT, which again is deferral, not mitigation. You get the mitigation of stamp duty and land tax, but bang, you've got the capital gains tax latent gain. And we've had a couple of clients who have just said, well, how do we finance that? Because it's a personal gain, which you personally have to pay for it. You've moved all your properties to a limited company. Your company can refinance it, but then, well, how do you get the money out? You're going to have to extract that. So the buy, refurb, refinance strategy for incorporation, which I will create a video for that, isn't always the best thing.
And isn't it always the case? There are so many fantastic property strategies out there. Some of them naturally go together beautifully. Some of them do not.
Before we go any further, I want to explain that there are many live events that you can register for free. There are 4 events that's showing: HK to UK to help people move from Hong Kong to the UK, the Property Expert Panel. If you're a property investor and property developer, this will be very useful for you. Tax Q&A, if you want to ask proactive tax questions in regards to structures and how to mitigate tax in the future. And finally, UK tax return Q&A, as it says, to deal with questions in relation to your tax returns before you submit it to HMRC. Don't forget that these events are live and will be shown on YouTube the day after. So why not register today, start saving tax tomorrow.